let's first start with the context, because I think a lot of investors that started their journey a couple of years back are facing their first real bumpy ride over the last couple of months. So what initially will you say, just to set the context of where we are likely to, or what we are likely to see in the coming months and especially over the next year?
Hey, Alex. Yeah. To set the context, I think what is important to understand and know is when markets are in the uptrend, everybody's an optimist and long-term investor. And when markets are in downtrend, everybody becomes a pessimist and a short-term trader. But the success lies when you are always balanced and in between, trying to play in a way where you are always diversified across different asset classes based on your risk appetite and your time horizon and your goals in life. And that's where wealth creation really happens. So focus on long term is more important than worrying about what has happened in marketplace over the last 6 months, especially when last 2 years have been so really rewarding for the equity investors. So keep in mind that recent past and not just recent months into picture when you are looking at anything about equity markets today.
You've shared with me a few lessons that can be learned from the recent past in the equity markets. And the first one that you pointed out was market rise is not linear. I think the tendency when you look at the long-term chart and you see an upward trend line is to expect that that's going to take place. Or you see returns from point A to point B, like I mentioned, 7,500 to 18,000. You don't really look at what happened in the interim, right?
Yeah. So you rightly said, Alex. Markets returns are never in linear fashion, and because we look at returns which are trailing returns or compounded annual growth rate projected returns of the last 1 year, 3 years, 5 years, 7 years. What happens is the underlying volatility gets completely hidden. And even if you look at 2020 as a calendar year, you would probably, looking at the return for 2020, you would not even realize that there was a crash of almost 38% in the month of February and March, while market recovered pretty quickly by the month of December. The CAGR or the compounded annual growth rate returns, which are shown to people for equities and people tend to look at them, they always hide the volatility. So you should look at that and understand that market will always have ups and downs, as the economy has ups and downs. And you need to look at the ups and downs in ways to book profits when you have substantial gains, and look at downs as a way to enter at a cheaper price and average out your cost of purchase instead of looking at it as a loss. So if you look at both these as opportunities to make money, you would probably in a better fashion than looking at the CAGR in isolation and expecting that it is going to be one-way street for returns.
Other aspect is if you look at asset allocation, and we've kept talking about it on this program, but you have to look at your portfolio, I guess, like a patchwork quilt, right? Where you have different allocations. This, more than anything else, would talk to that important point, right? The fact that not all assets or assets don't move in tandem, and therefore it is important to have that asset allocation strategy.
Yeah, absolutely. I think we've on this show we have talked zillions of times, every time, that what matters is the asset allocation that your investments have, and not which investment instrument you hold. So whether you buy mutual funds or you directly invest in equities, the fact is you need to have enough cushion in your portfolios to be able to give you that comfort to ride the waves. So when markets, we are always typically most people hold their equities in demat account, or they actually use some kind of apps like ET Money app for investing in mutual funds. And if your portfolio is heavily invested or having only equities and asset class, and you're somebody who's probably actively tracking markets and tracking portfolios, chances are very high that last few months would not have been comfortable for you. You would be seeing more red. and because you see more red, you become more kind of tense, you become more stressed out, and that stress basically makes you look for reasons, look for opportunities, look for excuses to take actions which may be averaging out down when it is not really needed, or basically exiting in a loss, which again is not desirable. So having a portfolio where you see less red or rather orange, or if not green, is far better than actually having all money is only in equities. So having a whenever you're looking at your portfolio, having a diversified asset allocation within your portfolio will give you a feel that not everything is falling like a knife. So look at your entire net worth as total consolidated number, rather looking at your equity portfolio or mutual portfolio. If you're suffering a 10% loss on entire net worth, it may not be really big. But in the essence, on your mutual fund portfolio or equity portfolio, you may be suffering 30% loss or 25% loss, which may be very, very concerning. But don't look at that in isolation. Look at entire portfolio, your net worth, and look at that. If that is 5% down, doesn't matter. Nothing matters like that number in short run. Ultimately, you're investing for long term. So having a consolidated view towards your wealth will make you take far informed decisions, and building a diversified portfolio and staying diversified as an approach to investments than actually putting only money in equities.
No, absolutely. In fact, there is that tendency to bet on the winners, right? And those winners don't always stay constant. But the third point that you've made is that making money from speculative trades doesn't last forever. And I think that is a tendency that is quite evident in a bull market, because as they say, the rising tide carries all boats, and you saw quite a few stocks that came out of nowhere and that became outperformers. But that doesn't take you very far, does it, Santosh?
Yeah, of course, Alex. I'm no personally speaking, or looking at investors and interacting with them over the course of this journey of 18 money, we realize that you basically, when you trade more or you actually are way too active investor, you tend to go with the recent winners all the time, and that would mean that you would basically end up buying an IT fund or a digital India fund kind of stuff, or maybe a pharma fund in 2020, and then betting on infrastructure or commodities, or some kind of energy related funds or stocks in 2021, and then coming in 2022, that all of that winning run has actually ended, has not really gone anywhere. Because what happens when you only look at winners, you tend to trade in them. And when you trade in winners, chances are very high that they'll be losers or they'll become neutral at some point of time. And you would not know when that is going to happen. And if you don't exit and book your gains, then ultimately returns tend to go towards mean, which is what a diversified mutual fund will give you. So, and sometimes if you get your bets wrong, even that return will not come. So what matters is not going after some kind of tips or looking at social media for inspiration to invest in next big idea, or for that matter, churning too much in your mutual fund portfolio.
Well taken about the fact that speculative trades might net you a little bit of money here and there, especially in a bull market, but the guarantee or the probability of winning is not very high, especially if you're talking about a market like we're seeing right now. But let's also talk about advice, right? Because we're in the business of getting the best advice, but the problem is that over the last couple of years in that bull market, you saw a lot of people that were dispensing advice. If you're talking about cryptocurrencies or you're talking about specific stocks that would be the next multi-bagger, that needs to be taken with a pinch of salt, right?
Of course. So, as I said in the beginning of the show, Alex, what happens is in a bull market, everybody is an optimist, and in a bear market, everybody is a pessimist. So, look at what social media chatter was all about in late part of 2020 and early 2021. It was all about this time is different, and we are going to see the rise of new India and new economy, and everybody's going to make money. And look at the chatter today. Everybody's concerned about inflation, and central banks across the world cutting down the free money or liquidity and actually increasing interest rates, which is going to impact the market. So the what happens is when you are looking at the media, especially social media, which is user generated content, what happens, you will always see polarized behaviors. You will always see extreme reactions. And as we kind of mentioned multiple times on the show, market is about extreme, but your portfolio cannot be about extremes. Your portfolio is about balanced. If you stay balanced, wealth gets created over long periods of time. And before you look to inspiration for next investment idea on social media or any kind of blogs, any kind of YouTube video influencers and things like that, always look at the credentials of the influencer or the expert you're following, because they are supposed to create content, they're supposed to create investment recommendation or advice for their followers. What happens is the market news or the current market events tend to dominate their discourse a lot, and by definition that creates panic in our minds, or it creates a lot of excitement in our minds to go with the flow. So instead of looking at that as a way to inspire next idea, always look at them as a way to gain knowledge and take your own decision based on your risk appetite, your life goals, and your existing asset allocation investments, rather than actually saying one needs to be overdosed into equities or underdosed in equities.
One final very important point, and I thought that this was very insightful, Santosh, is that as an analogy, you don't know that you're afraid of heights till you're standing on the edge of a very tall building or at a very high point. And similarly, when you have faced your first major loss in the equity markets or in your investment journey, that's when you're able to gauge in reality what your risk appetite is or your ability to take risk is, right? So would you say that people should utilize this to see what kind of allocation they should ideally have in equity and cut down if they're not able to stomach this loss?
Yeah, yeah, of course, Alex. So, if you always invest with your risk appetite in mind, then you will not really suffer losses which are undesirable in portfolios. What I mean to say here is, if you invest looking at past returns and expert advice on social media, what will happen is you would tend to go with the winners or the investment recommendation, which is generalized in nature. But no, your investment horizon and your risk appetite may not be in sync with what the general population is all about. And that's where the dissonance happens and you end up having bad experiences. Typically, you should understand if your horizon is like 3 years or 5 years or 7 years. Each of these different horizons require a different portfolio mix and different approach to investments than actually having equity funds in for all the three kind of investment horizons. So looking at that helps. In fact, I would look at not just risk profile in isolation. I would look at, do you really tend to make adjustment to investment plans if markets are like these? So if you are somebody who has felt to the need to book losses or stop your SIPs, that means you actually are not suited to a full equity portfolio. So you should do one exercise and understand whether what kind of investor you are. And ET Money has an option where you can understand your investor personality in far accurate manner than actually what you can judge yourself by some kind of minor events. And one important thing to note down always is, we say that we are prepared for losses and we are committed to long-term investments. But a 10% loss on a 1 lakh rupee portfolio is just 10,000 rupees, and 10,000 rupees may not be a very large sum for you to cough up, but or lose sleep over. But the same 10% loss or a drawdown on a 10 lakh rupee portfolio sums up to 1 lakh rupees, and 1 lakh rupees for many may be large amount to not lose sleep over. So it is not just percentage number which decides your risk appetite. It's also about how much loss you can fathom when the correction comes in. So look at things in a very balanced manner. Look at how important the goal is for you to achieve. Look at the risk appetite, look at the time horizon, look at the valuation of the marketplace, and have a methodical approach to creating portfolios and book profits periodically, than actually staying invested all the time in buy and hold approach. It may not work all the time. So having expert advice or something like what we offer in the ED Money brand is ED Money Genius, which is an investment intelligence service where you can actually create portfolios, is far better way to create and methodical approach to investments than blindly following SIPs and investing in mutual funds at all levels.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.